Hey everyone, you've been digging into Occidental Petroleum, and now you want to know if management's been delivering for long-term shareholders. Well, you've come to the right place. We're going on a deep dive into over a decade of their financial reports. We're talking 2000 to 2011. We've got annual reports, SEC filings, all that good stuff. It's like a financial detective mission to see if management's actions actually match their words.
What I find fascinating is that this period covers some major shifts in the energy world. We'll see how Occidental dealt with everything, from returning to Libya after they were forced out in the 80s, to all those crazy ups and downs in oil and gas prices. And of course, we can't forget about their move into shale. That was a huge gamble back then.
So we're not just looking at numbers in a vacuum. We're really trying to understand the decisions they made. But before we get into all the details, how do we even measure if management was successful? Like, what are the key things we should be looking at?
That's a great question. To gauge management's execution, we're going to look at four key areas. First up is production growth. Did Occidental actually increase their oil and gas production like they said they would? We'll look at specific examples like the Eden Uturi field in Ecuador and the impact of some of their big acquisitions like Altura, which was a big player in the Permian Basin.
Okay, so it's not just about pumping more oil. It's about making smart acquisitions and developing new fields. Got it. What's the next thing on the list?
Reserve replacement. You can think of it like a bank account for an oil company. They're always taking out oil and gas, so they have to put new reserves in. Otherwise, they'll run out. We're going to see if Occidental was actually able to find enough new oil and gas to replace what they were using, because that's really important for long-term value.
So they can't just rely on what they already have.
Yeah.
Makes sense. What else are we looking at?
Next up is financial performance. We'll dive into their earnings, cash flow, and how their dividends have changed over time. Basically, we're trying to see if they had consistent financial growth and if they managed costs well. And of course, if they rewarded shareholders with those dividends.
Ah, yes, the bottom line. That's what investors really care about. Okay, so what's the fourth area?
Capital allocation. That basically means, did management invest the company's money wisely? Were those multi-billion-dollar acquisitions actually worth it? Did they balance investing for growth? With returning value to shareholders, we'll dig into those big decisions and see if they paid off.
Okay, so we've got our roadmap. Now let's start with some of Occidental's wins. Those moments where management really seemed to hit it out of the park. What are some examples of successful execution?
Let's go back to 1998. Occidental acquired the Elk Hills oil and gas field for $3.5 billion. By 2003, they had already made back their entire investment, just from the cash flow. That's what I call a home run. But they didn't stop there. They didn't just extract value. They actually more than replaced the reserves they used up, which shows a really solid long-term strategy.
It's pretty impressive. But was Elk Hills just a lucky break? Or can we see a pattern of smart acquisitions? What about their stuff outside the U.S.? Did their international growth strategy work out?
They've had some really good wins internationally. Remember how they were forced out of Libya back in '86? Well, they went back in 2005. And by 2007, they were already producing 22,000 barrels of oil equivalent every day from their Libyan assets. They also made a move into the Middle East with the Dolphin Energy Project, which is all about natural gas. By 2008, their share of production from Qatar, which is a key part of the Dolphin Project, reached about 126,000 barrels of oil equivalent per day.
So they were doing well, both in the U.S. and abroad. But consistent financial performance is key. Did Occidental consistently deliver good returns for shareholders? What about their dividend history?
Occidental has a strong track record of giving back to shareholders through dividends. They've kept those dividend payments coming, even when the oil and gas industry was going through tough times, which is a really good sign for investors who want that reliable income.
That consistency definitely says a lot about how committed they are to their shareholders. It sounds like Occidental's management has done a pretty good job overall, delivering solid returns and growing their business globally. But no company's perfect, right? There have to be some areas where they face some challenges, or maybe even fell short of expectations. So let's switch gears a bit and explore those moments where things might not have gone so smoothly.
Yeah, you're right. Even the best companies have some rough patches. To really understand if management did what they promised, we got to look at where those promises might have fallen short.
Okay, so where do we see those cracks? What were some of the challenges that Occidental's management had to deal with?
Well, remember how great that Elk Hills acquisition was? Even with that win, Occidental's been fighting declining gas production in California. In 2002, they were producing 281 million cubic feet of gas per day in California. But by 2003, it had dropped to 246 million.
So even a smart acquisition can't change the fact that older fields just produce less over time? Kind of feels like Occidental might have been a little too optimistic about their California strategy.
It definitely shows that geology doesn't always care about the best laid plans.
Yeah.
It also makes you wonder about diversification. Did they put too many eggs in the California basket? Were they too reliant on that gas? That's something investors should think about.
Yeah, that's a good point. It's all about managing risk and having a balanced portfolio. And speaking of risk, we can't ignore the elephant in the room. Oil and gas prices, they're always going up and down. And Occidental, just like any other energy company, is stuck dealing with those swings.
Exactly. Take a look at their average oil prices in 2006. They were all over the place, like $52.40 a barrel in Latin America to $61.58 in the Middle East and North Africa. That's a big difference. It shows how prices can change based on where they're producing, and that definitely affects their profits.
So those price swings can really make a huge impact, depending on where Occidental is selling their oil. It must be tough for investors to figure out what future earnings will look like with all that uncertainty. What about natural gas prices? Did they see those crazy ups and downs there too?
Oh, yeah, for sure. In 2006, they were getting an average of $6.51 per thousand cubic feet of natural gas in the U.S., but in the Middle East, it was only 97 cents. That just goes to show how complicated it is to manage oil and gas assets all over the world, and how hard it is to deal with all those price risks.
It sounds like they're always walking a tightrope, trying to guess where prices are going. I'm making the right decisions.
Did Occidental do anything to protect themselves from all this volatility? Well, smart management teams usually use things like hedging strategies to try and smooth out some of those price swings. But they also focus on what they can control, like production costs.
So it's even more important to keep costs down. When prices are unpredictable, did Occidental do a good job of that?
Their average global production cost in 2006 was $11.23 per barrel. But again, it really depended on where they were producing. $12.83 in the U.S., $10.02 in Latin America, and only $2.76 in the Middle East and North Africa.
Wow, that's a huge range. Why were the production costs so different?
Well, a lot of things affect that, like how complex the oil fields are, labor costs, infrastructure, and even government regulations. It adds a whole other layer of complexity when Occidental's trying to manage all these different places.
So we've got fluctuating prices, different production costs. What other challenges might have gotten in Occidental's way? Didn't we mention environmental stuff earlier?
Yes, and those can be a big deal. Environmental liabilities, often from past practices or accidents, can cost a lot of money. Occidental has put a lot of resources into cleaning up environmental problems, which is important, of course, but it can eat into profits and take money away from other opportunities.
It's a good reminder that producing oil and gas isn't just about drilling and pumping. There are long-term consequences for the environment, and companies are being held accountable. How did Occidental balance those responsibilities with their financial goals?
That's a really important question for investors. Did all that environmental cleanup work affect their ability to keep their financial promises? Did they find the right balance between taking care of the environment and giving back to shareholders?
It's definitely a tough balancing act. So we've got environmental concerns, volatile prices, and production declining in some areas. Anything else that might have tripped up Occidental's management?
Let's go back to those unconventional shale opportunities we talked about before. They were seen as high risk, high reward, and they didn't always work out the way people hoped.
Right, we talked about how risky it was to jump into those new and unproven areas. So did those bets pay off for Occidental, or did they backfire?
It's kind of a mixed bag. Some of their shale investments did well, but others were a lot more challenging. Shale is complicated, even for companies with a lot of experience.
So even with the best technology and expertise, there's still a lot of uncertainty when you're dealing with shale. It shows how risky it is to invest in oil and gas exploration. Did Occidental handle those risks well? Or did they bite off more than they could chew? That's something investors need to consider.
Absolutely. That's why it's so important for investors to do their research. Don't just look at the headlines. Really dig into a company's track record, their management, and their overall strategy.
Okay, so we've looked at the good and the bad. What's the verdict on Occidental's management? Have they been able to keep their promises to long-term shareholders?
Well, we've seen both good execution and some bumps in the road. They made smart acquisitions like Elk Hills, expanded internationally, and kept those dividends coming. But they also had to deal with production going down, unpredictable prices, environmental issues, and all the uncertainty around shale.
Right. We've seen how things outside their control, like oil and gas prices, can really affect their bottom line.
Oh, hey.
But we've also seen how their own choices, like investing heavily in California gas, can make them vulnerable to more risks.
Exactly. And that's why it's so important for investors to really look closely and figure out if Occidental's management has been making good decisions, decisions that create value for shareholders in the long run.
Okay, so we've covered a lot, but there's one big piece of the puzzle we still need to talk about. Remember that huge investment Occidental made in the Al Hosn gas project back in 2011?
Ah, yes, the Al Hosn gas project. A multi-billion-dollar gamble on natural gas. It was a risky move, one that could have a huge impact on Occidental's future growth.
And you, our listeners, want to know if those big investments actually paid off for shareholders. We've looked at their successes and their struggles, but this project was a major shift in strategy. Will it be the crown jewel of their portfolio? Or will it drag them down? We're back and ready to wrap up our Occidental Petroleum deep dive. We've seen the good times, the tough times, and now it's all about that potential game changer, the Al Hosn gas project. This was huge, GE. Billions of dollars poured into the world of natural gas.
Bold. Definitely a bold move. Occidental teamed up with the Abu Dhabi National Oil Company. They wanted to squeeze out over 500 million cubic feet of natural gas every day from this project, enough to power a whole city.
Seriously. But spending billions doesn't mean automatic success. Did Occidental actually see a return on all that money? Did Al Hosn live up to all the buzz?
Well, to give you a complete answer, we'd need info past 2011, which is where our data stops. But we can work with what we've got. By 2011, Occidental's share of what they were producing in Qatar, including that Dolphin Energy project that feeds into Al Hosn, hit about 126,000 barrels of oil equivalent per day.
Okay, not bad at all. But Al Hosn wasn't about quick wins. It was a long game. Did they manage to fit this massive project into their existing operations, while still dealing with all those other headaches, like production going down and prices bouncing all over the place?
That's the big question. Al Hosn wasn't supposed to be at full steam until 2014, so right after they invested, it was all about getting things built and ready to go.
So the early years were all about setting the stage. But were there any signs that Al Hosn was having a good impact even before it was fully up and running?
Definitely. Buying a 40% stake in Al Hosn gave their natural gas reserves a huge boost. By 2011, Occidental was sitting on a mountain of natural gas reserves, 5.32 trillion cubic feet globally. It shows they were serious about shifting towards natural gas, which was seen as cleaner and in high demand for the future.
So their reserves were piling up. But what about the actual production? Were they able to pump out more overall, even with those problems in other places, like California?
Their worldwide production did drop a little in 2011. Down to 603 million barrels of oil equivalent from 607 million the year before. But don't forget, they were also selling off some assets, which affects those numbers.
Right, so maybe those sales are hiding the real impact of Al Hosn. It's like trying to measure how fast a tree is growing while you're trimming off branches. Were there any other clues that Al Hosn was on the right track?
Their capital expenditures tell an interesting story. In 2011, they dropped $460 million on Al Hosn alone, plus another $500 million for pre-acquisition development costs. Almost $1 billion in 1 year, just for this project.
Whoa, that's serious cash. They were clearly all in on Al Hosn. Did they think they have to keep spending that much?
They did. Occidental figured they'd need about $3 million more until Al Hosn started pumping at full capacity in 2014. It sounds like they really believed in Al Hosn's long-term potential, even though it needed a ton of money up front.
So billions were flowing into this project, but was it actually helping their overall financial performance? Were they staying profitable and taking care of shareholders while they were bankrolling this huge project?
Their net income definitely went up and down in the years after they invested in Al Hosn. Big drop in 2009, down to $2.9 billion, then bounced back to $4.5 billion in 2010. By 2011, they were making serious cash from their operations, hit $10.2 billion that year.
So the finances were looking okay, even with those huge Al Hosn investments. But for long-term shareholders, it's all about creating value. Did this project and their whole strategy actually deliver?
That's what we've been trying to figure out this whole time. Our data only goes up to 2011, but we can make some judgments based on what we've seen. Occidental is a company that's not afraid to take risks, like buying Elk Hills or investing in Al Hosn. They've also shown they care about shareholders with those consistent dividend payments.
Yeah, they're willing to make calculated risks, which you sometimes need in the oil and gas world.
Yeah.
But they've also had some rough patches, declining production, Unpredictable prices, environmental issues, and the whole shale gamble.
Exactly. The key thing for investors is that there are always trade-offs, risks, and things you just can't predict. Occidental's management made some smart moves and had some big wins, but they've also had to deal with things that have really tested them.
So did Occidental's management keep their promises to long-term shareholders? It's complicated. We've seen both good and bad. They've set themselves up for growth, but did those big bets pay off, especially Al Hassan? We'd need to see beyond 2011 to know for sure.
You got it. This deep dive has given you a good understanding of Occidental's history, their plans, and all the things that affect how they perform. But just like with any investment, the story keeps going. The energy world is always changing, and Occidental will definitely have new challenges and opportunities in the future.
That's what makes investing so interesting. You're always learning, adapting, and trying to make good decisions based on the best information you have. We hope this deep dive has given you the knowledge you need to keep looking at Occidental or any company with a critical eye. Until our next deep dive adventure, keep exploring, keep asking questions, and keep learning.